Welcome to The Explainer. Today, we're tackling a huge concept in investing, portfolio risk. We're going to go way beyond just picking winners. Let's get right into it. This is the question every single investor has to ask themselves, right? How do you actually grow your money without, losing your shirt? It's this constant tug of war between chasing those big returns and, at the same time, making sure you don't get wiped out. It's a tough spot to be in.
So, to really start untangling this whole dilemma, we've got to get specific about what risk even is. It's not just some scary, vague idea. In the world of finance, risk is something you can actually put a number on.
Okay, so if we're looking at just one thing, say a single stock, its risk is really all about its volatility. How much does its price jump around? The fancy term for this is standard deviation, but all it really means is how wild the ride is, how much the price swings up and down around its average.
All right, let's put that into practice. Imagine you've got two stocks. Stock A has a standard deviation of 10%, and stock B is way up at 20%. It's pretty obvious, right? Stock B is the wilder, riskier bet of the two. So far, so good.
And this is where it gets really, really interesting. Your common sense is probably going to lead you astray here. You think, okay, I'll just average the risk of all my stocks, and that's my portfolio's risk. Nope, it doesn't work that way. There's a secret ingredient we haven't talked about yet. And that secret ingredient, the thing that changes the entire game, is a little something called correlation. So what is correlation? It's all about how two assets dance together. It measures if they tend to move in the same direction at the same time or if one zigs while the other one zags. It's the relationship between them that matters. Okay, look at this. A correlation of +1? That means they move in perfect lockstep. Think synchronized swimmers. 0 means their movements are totally random, completely independent. But -1, that's the magic number. That means they're a perfect seesaw. When one is up, the other is down. And that, right there, is where you get the biggest bang for your diversification buck. And you see this stuff in the real world all the time, right? Think about two big tech stocks. They're probably going to react to the same industry news, so they have a high correlation. But what about something like gold compared to those tech stocks? Gold marches to the beat of a different drum. It reacts to totally different economic forces. That means it has a low correlation, and that's super useful. So, getting a grip on correlation. That's how you unlock the real magic of what we call diversification. Let's break down exactly how this works. The whole point is this. If you own a bunch of different things that don't all move together, you're basically making a bet that they won't all crash and burn on the same day. The hope is that while one part of your portfolio is having a bad time, another part is doing just fine, or maybe even going up. It smooths out the ride. Okay, let's circle back to our two stocks. Remember? We had asset A with 10% risk and the much riskier asset B with 20% risk. Let's say we build a super simple portfolio and put half our money in each. Now, simple math would tell you, okay, 10% plus 20%, average that out, the risk should be 15%. That's what your gut tells you, right? But here's that magic I was talking about. If their correlation is 0, meaning they move independently, the actual risk of the portfolio is lower than 15%. It's crazy. Because they don't move together, their volatility kind of cancels each other out, and the whole portfolio becomes less bumpy. So here's the key takeaway. Diversification is awesome at getting rid of what's called unsystematic risk. That's the risk tied to one specific company going belly up. But, and this is important, it can't save you from systematic risk. That's the big stuff, like a whole market crash where pretty much everything goes down together. Okay, so we've established that we can mix and match assets to bring down our total risk. That naturally leads to the next big question. How do we find the perfect mix, the absolute best combinations out there? Well, there's a really powerful tool for that, and it comes from something called modern portfolio theory. It's called the efficient frontier. Just think of it like a treasure map for investors. It shows you where all the best possible portfolios are. So how do we read this map? It's actually pretty straightforward. Along the bottom, the x-axis, you've got risk. The further right you go, the riskier it gets. And going up the side, the y-axis, that's your expected return. The higher up, the more money you hope to make. Now, let me ask you a question. Imagine you're offered two portfolios. They have the exact same amount of risk, say 10%. But portfolio A is expected to return 12%, and portfolio B is only expected to return 8%. Which one are you going to pick? It's a total no-brainer, right? You take portfolio A every single time. And that's exactly what the efficient frontier is. It's that beautiful curve that connects all of the portfolio A's. For any level of risk you're willing to take, the portfolio on that line is the one that gives you the maximum possible return. Anything sitting below that line, it's just, well, it's a worse deal. You'll notice the curve starts at one specific point, all the way to the left. That's called the minimum variance portfolio. It's the holy grail of safety, the one specific mix of assets that has the absolute lowest possible risk you can get. It's the starting point for everything else. So, after all that, what's the big picture? What does this all mean for you and me? Honestly, it should completely change how you think about investing. The real takeaway is this: smart investing isn't about just trying to pick the next superstar stock. It's much more like being a coach, building a team. You need players that work well together. How your assets relate to each other, their correlation, is just as crucial, maybe even more so, than the individual strength of any single one. So this really leaves us with a powerful new lens to look through. It's a fundamental shift, right? To see risk not as a property of a single stock, but as a product of relationships. Which leaves me with one final question for you to think about.